Welcome to the Stuff You Should Think About podcast, where I answer everyday questions about phenomena and objects. Hey, how's it going? I'm G, and today we're going to talk about mortgage, all the way from the front door to like the big shiny building on Wall Street. And yeah, it sounds dramatic, but this is really what happens behind the scenes. So, we'll start with a super normal picture. You buy a house, right? You sign this stack of papers that feels like a phone book, right? Somewhere in there is your mortgage. Let's say your payment is, I don't know, $2,000 a month. Where does that actually go? Part of that is paying back the money you borrowed. That's the principal. Part of it is interest. Basically, the rent you pay for using the bank's money. And then, depending on how it's set up, you might also be paying property taxes and homeowners insurance into this little side bucket called escrow. The bank or the mortgage company holds that and pays the tax people and insurance folks for you. So, from your point of view, you just see one payment leaving your account every month. But behind the curtain, that payment's already being chopped up. Some of it goes to the lender as income, some to the government for taxes, some to the insurance company, maybe a little fee to the company that collects the payment. Now, here's the part a lot of people don't realize. The bank usually doesn't keep your mortgage forever. They just don't tuck it in a drawer and wait, 30 years. They want their money back faster so they can go make more loans. So pretty much most of the time they sell that mortgage. You might get a letter in the mail that says, hey, don't send payments to lender A anymore. Send them to lender B. That's your hint that your loan probably got sold. The rules of your loan stay the same rate, same payment, but the owner in the background changed. And they're not just selling yours, they're bundling your mortgage together with a whole bunch of other people's mortgages. So don't feel alone. Imagine every homeowner on your block, plus every homeowner in 5 other neighborhoods, all tossing y'all's payments in one bucket. That's a pretty damn big bucket of cash pouring in every month from all of y'all paying your mortgages. And somewhere on Wall Street or in some big financial company, that bucket has a formal name. Yep. It's part of something called a mortgage-backed security. That's a fancy phrase. All it really means is this investment is backed by a whole pile of home loans that you all are paying on. Your whole block is paying on this, and that's what it's backed by. So, quick recap before we move on. You make a payment. Your lender usually doesn't keep the loan. They sell it. And in the background, your payment is just one toothpick in a giant pile of wood that we call mortgage payments. So next up, we're going to talk about how that pool gets sliced up and sold. Basically, like you're turning that bucket into an investable pile. All right, so we got this bucket of mortgage payments, right? All these homeowners, all paying every month. What do the money people do with that? They turn it into something other people can't invest in. Picture this. You and a bunch of friends order a huge pizza. No, nobody wants the whole thing. Everybody wants a slice or two, so you cut it up. That's basically what happens with that big pool of mortgages. Instead of selling one giant thing, they slice it into pieces and investors can buy those slices. Those slices are pieces of a mortgage backed security. When an investor buys a slice, what they're really buying is the right to get a share of all those monthly payments flowing into their pool. They don't own your house. They're not your landlord. They're just getting a cut of the payments. Like being in on a group order. Now, who actually buys this stuff? It's usually not some guy day trading in his basement. It's big, boring sounding institutions, pension funds that people's retirements, this is what they pay in. Insurance companies that need steady money coming in so they can pay claims. Mutual funds that hold people's 401k savings, and sometimes banks too. They like these things because in normal times, people try really hard not to miss their mortgage. So the cash flow is pretty steady. Month after month, money drips in. In return, those investors get interest. Kind of like you get an interest in a savings account, just usually bigger and more complicated. Here's where it gets a little technical, but I'll keep it simple. That pizza, it's not all created equal. People in charge don't just cut equal slices, they make layers called trenches. Don't worry about the word, just think tiers. The safest tier gets paid first. So when all the mortgage payments hit the bucket, the cash flows to the top. Safe. Sliced before anyone else. Because it's safer. That slice usually pays a lower interest rate. You're getting less reward because you're taking less risk. Then you have middle slices. And finally, the risky slices at the bottom. Those risky pieces are like, all right, you get paid last. If people start missing payments, you're the first one to feel the pain. But in exchange, when things go well, they can pay a higher return. High risk, high reward. Low risk, low reward. That's the basic trade-off. So inside one big pool of mortgages, you've got this whole staircase of slices. People who want something super safe take the top steps. People willing to gamble more move down the stairs, hoping to earn more. And all of this is built on your payment, my payment. Everybody making their boring monthly mortgage payment on time. If you're thinking, okay, that actually kind of made sense, you're right. In theory, it's a clever way to match different types of investors with different levels of risk. In the next part, we'll talk about why this whole structure matters for regular people and how before 2008, folks pushed it way too far and the whole thing cracked. So why should you care that your mortgage turned into this sliced up pizza on Wall Street? Like, What does it do for you besides make your brain hurt a little? When this system works the way it's supposed to, it actually helps everyday people. Remember how the bank sells your loan to get its money back sooner. That means they don't have to wait 30 years to be repaid. They can use that cash to go make more loans, maybe to your cousin who's buying their first place, or to you again if you refinance. Investors' pension funds, insurance companies, all those folks are basically providing the money behind the scenes. Because there's this big global pool of investors willing to buy those mortgage slices. There's usually more money available for home loans. More money chasing mortgages can help keep interest rates lower than they might be otherwise, and it keeps the credit pipes flowing. But, and this is a big cut, before 2008, things went off the rails. The basic idea was the same: bundle mortgages, slice them up, sell them. The problem was the quality of the mortgages was going into the pool. Imagine a town where lenders start saying, hey, we'll give almost anybody a mortgage. People with shaky income, low savings, complicated situation folks who might struggle if anything goes wrong. A lot of those loans had low teaser rates at first, then jumped higher later. On paper, it looked fine. In reality, there were a lot of people right on the edge. Those riskier loans still got bundled up and sold. Some investors trusted complicated models and high credit ratings and kind of assumed, well, even if a few people don't pay, pool is still big. We'll be fine. But when home prices stopped rising and people's payments reset higher, way more than a few started defaulting. Once enough homeowners couldn't pay, the cash going into those big buckets shrank. Remember the slice system? The riskiest slices got hit first. But the losses didn't politely stop there. They spread. A lot of investors suddenly realized what they owned was way riskier than they thought. Confidence broke. And because this stuff was tangled through the whole financial system, it helped trigger the 2008 financial crisis. Since then, a bunch of things have changed. I won't drown you in regulation names. But at a high level, lenders generally have to check more carefully that you can actually afford the loan. There are rules around verifying income and documents. Some of the really wild, no documentation loans that were common back then are a lot harder now, especially for loans that end up in big, mainstream mortgage-backed securities. There are also more rules about how these mortgages pools are put together and how risk is disclosed. It's not perfect. Nothing in finance ever is, really. But the idea is to make it harder to stuff a pool full of super shaky loans and then pretend it's all safe. So, trying this all back, your mortgage doesn't just live in a file cabinet. It becomes part of a system that, when it's healthy, helps keep money flowing and borrowing costs reasonable. When people get too greedy or too sloppy about risk, that same system can cause a ton of damage. All right, I'm going to stop there before this turns into a whole mini-series. If this helped you see the path from your living room to Wall Street a little clearer, cool. We'll dig into more money stuff like this in future episodes. But for now, keep making that boring payment and maybe feel a tiny bit smug that you know where it actually goes.